Welcome to Property Banter by Pinnacle Buyers Agents. My name's Michael Lezaja, and today I'm going to be talking about the suburbs in Melbourne not to invest in. And if you're looking to make money in 2026, these are your no-go zones. Let's go. Okay, so in this episode, we're going to be talking about what suburbs we're definitely not buying and what suburbs you shouldn't be buying as well. You need to stay away from these areas if you plan on making money in 2026. This episode is going to save you money and years of underperforming in the Melbourne market. So let's make it clear. This isn't about suburb shaming or calling an area a bad area, right? That's subjective. There's so many reasons why someone could call an area bad. This is simply just analyzing the data and the types of assets and properties that you'd be buying in these areas, right? And I really want to stress both of those, right? So we're going to be looking at the data set to break down those areas and what's going on, but also those types of properties that are there and that people, project marketers, financial planners, even mortgage brokers are hustling and trying to sell to their clients as a good investment that are absolutely shocking and definitely not worth buying. So definitely this is more so about analyzing the data and making sure that you are not put at risk and you're essentially going to make money over the next few years. The common theme of these suburbs is massive amounts of dwelling growth. So builders are obviously completing projects here at scale, and there's hundreds, if not thousands, get completed. Buyers have plenty of options. It's a very cookie cutter, new estate, house and land packages, and the buyers have plenty of choices when oversupply hits these markets. The renters have plenty of choices when supply hits the rental market. It doesn't create scarcity. Now, scarcity is what creates price growth. Okay, let's take a look at the red flags that all of these areas have in common. And the first one is an excessive amount of supply. The supply in some of these markets has grown just in the last couple of years by 30 to 40%, right? It's outstripped demand. These are the types of, new house and land package areas where these are sold. There's plenty of these sold to investors who are interstate. They don't have a look at, they don't research the metrics and the data showing what they are. People are buying these types of properties on depreciation, and they're really not looking at the fact that, house and land packages are what you shouldn't be buying, number one. And two, at the fact that there is so much supply in these actual markets right now. And that is definitely detrimental to price growth in the short term. So when there's an excessive amount of supply, buyers have plenty of choice. When buyers have choice, the supply outstrips demand, and then you essentially have a weak, sales market where the prices aren't growing because they're struggling to sell. There's not enough buyers, and the price doesn't go up. Prices go up when there's heaps of buyers competing for something that's scarce. Right? Same goes for the rentals. Rentals can't track upwards if there's too many rentals on the market because every investor there is trying to lease their house and land package that they bought off the plan, and they can't find tenants. And they're all competing to get the same tenant. The same tenant has so many choices in that house and land estate, and they're all cookie cutter, same type of properties, right? And these people, they've got their pick of wherever they want to live, and this, once again, doesn't create scarcity because there's an excessive amount of supply to the rental market, and that's what's keeping rental prices low. Now, there is a direct correlation between rental prices rising and house prices rising. When there's an excessive amount of supply in every way, shape, and form, it's detrimental and it stunts the growth of that market. And the investor investing in these areas is going to pay the price. And a lot of them are doing it because they've been advised by people who have a vested interest in selling that house and land package. And quite often, these people that are spruiking these house and land packages are taking between, $40 and $60, $70, $80,000 per commission, which is built into your price. So you're overpaying for this property because you've got to factor in the developer's margin, you've got to factor in the sales margin, and you're overpaying for this stock. Whereas, I'd always rather go buy an established area where it's found its level in the market I'm not paying excessive amounts of commission to anyone who's selling me the property. I buy the property hopefully under market value, but my supply and demand metrics aren't out like they are in these areas, and that property grows over the next 12 months, over the next 24 months, 36 months. These areas that I'm going to talk about are not going to grow. And if they do, it will be minimal, and it will be off the back of Melbourne growing in general, and these will move probably the slowest of the entire Melbourne market, hence why I've rated them as the worst places in Melbourne to invest. I just touched on vacancy rates. Now, vacancy rates are very important. A lot of these areas have super high vacancy rates. The high vacancy rate means that there's plenty of properties on the market to rent. When there's plenty of properties on the market to rent, there's a lot of competition, and investors who have just bought a house and land package, they need to get that property rented out because they have a mortgage. The majority of investors are mums and dads who are just trying to get by. They've unfortunately been sold an inferior asset in a house and land package, which, by the way, if you can't already tell by the theme, I'm not a big fan of them. We don't sell them, and I definitely advise all my clients against them. I have bought one in the past myself. So I'm here telling you through actual experience, not just because I'm dissing them because I don't do it. It's because I've done it. I've seen it. It doesn't work. And there are way better ways to invest. These markets are here, struggling to attract tenants because there's an excessive amount of supply. And then these landlords need to get them rented out as soon as possible. So they're hassling the property manager going, hey, I really need this rented out. I've got a mortgage to pay. And they're competing against, tens and maybe hundreds of others that are on the market at any one time for rent. And they're all the same. There's no uniqueness to them. It's not like it's got side access for your boat and it's got a pool and it's got this or it's got that. And then, you know what? It will rent easy because it's unique. No, they're all the same, 422, 322, 421s or whatever they are. And yeah, they're essentially competing against next door and the next door and the next street over. And it's really, really stunting the rental price growth. And as rental price growth, stagnates, it doesn't track upwards. Property prices don't really track upwards. The rental yield is compressed. And it's not the type of market you want to be buying in. On the flip side of the coin, you have a look at markets that have done really, really well over the last few years. They've all had a real lack of supply. They've had a lot of demand, and they've had low vacancy rates. And with the low vacancy rates, rents track upwards. And as rents rise, property prices rise as well. And that is the common theme to take away from all of the markets that have boomed over the last few years. These markets haven't done that, aren't doing that, and they're the worst place to invest right now. Now, another one is days on market. Have a look at days on market, right? There's one of these areas that has 263 properties for sale on realestate.com. And it is absolutely saturated with properties out there. Now, if you need to liquidate these assets, right? Because for whatever, life happens, right? And you might get, God forbid, you might get divorced. You might have a business opportunity you want to take up. You want to get rid of this for serviceability, whatever the reason may be. If you need to sell, you are going to struggle if you just bought a house and land package, because don't forget you're competing against everyone else who's in the same boat with the same cookie cutter property. And if there's others liquidating and trying to get out, which there is, because you have a look at hold periods, they're super low. There's a lot of turnover in these areas. You will struggle to sell it, and you'll be selling it at a huge discount just to get out of that market. But also you're competing with the developers on their future land releases. Right now, developers can offer on brand new stock, no stamp duty and all these incentives from the government to get people into those new ones, which will always keep your price low because they can always go buy the new version, right? This is why secondhand cars are way cheaper secondhand. When you drive them off the showroom floor, they lose a lot of value. And I always use the Toyota Corolla analogy. You can buy a new Corolla. Correct me if I'm wrong, but let's say you pay $30K plus for a new Corolla. If you buy a second-hand one with 40,000 Ks, it's already found its level in the market. It's 3 years old, and you could buy it for 17K, for example. It's better to buy the 17K Corolla and then even try and find a good deal of that 17K Corolla, underpay, and buy it for 15K. You've essentially got the same car as the $30,000 brand new Toyota Corolla. It's got a few Ks on it. It's pretty much the same car. So, things that are brand new lose money. It is what it is, unless it's highly collectible. And once again, limited edition, like a limited edition car, limited edition watch, all the things that are limited edition, and there's only a small amount of them in the world, like Bitcoin, like gold, or whatever it may be. It creates scarcity, and there's a lot more demand for that scarce item or product, and that's what drives the market up. Now, We're focusing on the Western Corridor of Melbourne because we know that's where these culprits are, not the project marketers that sold them, but more so the actual suburbs themselves. Now, the number one worst suburb that you can buy in Melbourne is called Rockbank. I don't care what anyone says. Throw it in the comments. Now, the suburb's not so much bad because it's got a high crime or whatever it may be, or I don't like the area or whatever. This is not an insult to anyone living there. This is simply just data backed. If you're an investor, you should not be buying here. You should not be buying a house and land package one, but you shouldn't be buying in an area where there's so much supply, so far out, so many building approvals right now. It's definitely one that I suggest you stay away from. Okay, cool. So let's dive into Rockbank. Let's go down. I want to show you this, right? Affordability. It's sitting at 30 years to own. 30 years, 25 years, 30 years to own, 35 years is all well and good. It is affordable, and that's a positive that this market has going for it. The biggest negative here is the fact that you got building approvals, 2.64%, 92 approvals here, whole period of only 4.77 years, which means stock is turning over. The issue here is the trend line. It's trending down. So it's not trending in the right direction. Everyone's offloading stock and everyone's selling. It means there's a high turnover. Now, I've seen markets like this in the past. These are big warning signals, right? Now, I watched Yarrabilba back in the day when it was heavily supplied and it was further out, and it was the best example of what Rockbank is right here in Brisbane. And these areas really, really struggled. And people that bought $450,000 house and land packages were offloading houses for $310,000 to $380,000, $400,000, and they were all losing money. And it took them 10 years to hang on to it for them to see that growth. Whereas during that period of time, our investors were all buying established and were all making money well ahead of these areas. And that area in Yarrabilba here in Brisbane, that only took off once everywhere else took off, and then it was last. Right? So you're waiting for your capital growth longer in markets that are saturated, and you want to avoid that, especially if you're looking to scale a property portfolio. You want to scale quick. If you need to scale quick, you need to buy something scarce, you need to buy something that's in demand, because that's where the price growth happens. So looking at this is definitely not ideal and something you definitely want to watch. Now have a look at this vacancy rate, 5.35%, and it's trending upwards as well. It's trending in the wrong direction. So it's getting worse. So for anyone looking this year to be buying in these areas where there's a mass amount of stock hitting the market, vacancy rates tracking upward, this is just, everything here is conducive to a stagnant market. I know that it's affordable, and that's the one thing going for it. But if you're looking to scale a portfolio, like I said, Rockbank is definitely not where you want to be in 2026. Okay, so Rockbank, when you look at the data and you look at house and land packages for what they are, they're just a rip-off. They are not what you want to be buying. If you are an investor and you're scaling a portfolio, that's the exact way to literally fuck yourself up. Yes, I said the F because I feel that I really need to express myself with the strongest amount of, to give you the most amount of warning here. It is how a lot of investors get stuck. And I don't want to see you jump out there, buy something you shouldn't be buying in an area where the data says you shouldn't be buying. And it's this combined double whammy of the worst possible asset class or asset type that you shouldn't be buying in an area that you shouldn't be buying it in. If it was different and it was a new land release and there's 20 blocks being released in a suburb that's close to the water, that's already built out, if there was a new land release somewhere, along that eastern side of Melbourne near the water, and they had 20 lots that were just released. If you wanted to do something like that, okay, cool. But where there's an excessive amount of land being released and new supply coming, stay away from it. Okay, the next one is Fraser's Rise. Now, you've probably heard about it. It is very, very similar. It's close to Caroline Springs, which is a little bit more established, but the amount of supply here is considerable, and it's somewhere that you should be very, very cautious about unless you're moving there to live. You should definitely not be investing there in 2026. Very little scarcity, a lot of cookie cutter style properties. And when you have a look here, let's have a look at this data. Fraser's Rise has the worst capital growth score as per the RCS metrics here. Right now, the RCS is a combined score, right? But it's rare that you will ever see a 1 out of 100 score for capital growth. And the reasons for that, I'm going to show you. Have a look down here. at ersatz scoring of 8, not too bad, right? Renters to owners, all that's fine. Years to own affordability at 27. I like that. These are affordable markets, and these markets will be dragged upwards purely based on affordability and the simple fact that the whole Australian market keeps tracking upwards. And eventually affordability will win. And people are going to go, okay, cool. Well, everywhere else has jumped 300-400K. I'm just going to go buy Fraser's Rise. This is going to happen. It's going to happen at some point. But if you're looking at building your portfolio this year and you're looking for your next buy, this is not where you go. This is not where capital growth lies within these suburbs and in these asset classes. But, having a look now at building approvals, take a look at this. 225 building approvals coming to this market. It's trending upwards as well. Hold period of 5.5 years. Yeah, huge red flags there. And see, they're highlighted in red. Definitely not the market you want to be buying in. Vacancy rate even higher than Rockbank, 7.22. Have a look at this, trending upwards. But look, it's just a heavy no from us. I definitely believe that there are better places to invest. And once again, for the exact same reason I gave you in regards to Rockbank, this is the exact same. Stay away from it. Next one is Tarneit. Now, Tarneit, if you want to make money, Tarneit is where you need to avoid. Don't go there, don't buy there, and definitely don't buy a house and land package there. I had a look on realestate.com. It has 263 listings. It has the most of these three mentioned, the most amount of listings, and it's absolutely crazy. Huge build volumes, very cookie cutter. The exact place you'd want to stay away from. Out of all of them, I'd still prefer Fraser's Rise due to its proximity to Taylor's Hill and Caroline Springs being very established and in demand areas. But still, it still doesn't help with the fact that supply is still very heavy in all of these areas. But you know what? Tarneit is a lot closer and a lot more established. It's a lot further along in its maturity curve than Rockbank, which is just getting established now and is the worst of the worst. It's the worst of the three. But this is all a moot point because the fact of the matter is you wouldn't be going anywhere near any of these areas whatsoever. Let's have a quick dive into Tarneit. So having a look at Tarneit here, the main points I really want to get to, data set looks a lot better than Rockbank and Fraser's Rise, but I really want to get to the biggest killers in this data set, which is the most important. Years to own 34, a little bit more unaffordable, higher pricing, but you know what? This is the issue. Building approvals. 1,307 approvals coming to this market. What the actual, right? So that's crazy. Look at the trend line heading upwards. There's a continuous supply coming to this market. Whole periods of 6 years. You know what? I foresee that declining shortly. I just think a lot of people are going to want to get out of these areas very soon. Days on market, 58 days on market. Not the best, but sort of standard. It's definitely not a boom market. So these types of markets sitting at 58 days are not going to perform the way you want them. If we're looking for that really solid capital growth, we want to see the 10 to 30 days on market, right? Vacancy rate at 3.71. Vacancy rate's a little better than the others, but still so much stock to be absorbed there in the rental sector. So honestly, I'm very, very anti these areas. I'm very anti house and land packages, and I'm telling you this from experience. It's something you should definitely stay away from in 2026 if you want to make money. But if you are looking for a 2026 playbook, I want you to have a look at this podcast we did just a couple of weeks back, and it talks about the types of areas and the types of strategy you should be buying. And I've even put the hotspot or where I'd be buying or where we are buying, right? So this is the exact strategy we use for our clients. And I've even highlighted the areas that we're investing in 2026, and we're actively buying in these areas right now for our clients, and it will give you a good insight as to why we're doing it. So, but look, in summary, definitely stay away from these areas. Stay away from excessive land supply, excessive building approvals, excessive completed dwellings, excessive stock on market, excessive amounts of rental vacancy, properties on realestate.com for rent. These are killers, and they will kill your portfolio. They'll kill your capital growth. And that money invested there is money wasted because that money could be somewhere else. And that's an opportunity cost is what we call that. That money could be somewhere else actually making money. Instead, you've got it invested in an asset that you've overpaid for on price. That's not worth what it is the second you own it, and the capital growth just isn't coming over the next few years. It will move upwards. It's just going to take a little bit of time, and it's not the first market to move in Melbourne. And if you are looking at markets in Melbourne that are going to move in 2026, it is the markets that aren't heavily supplied, that are built out, a lot more scarcity to them. Run your data set. If you need some help with any of that, you need some clarification on your strategy, please get in touch with us. Please like, subscribe. We appreciate bringing you this content. We appreciate you watching. We love bringing you this content. And until next time, take care.